Hi, welcome to this AQA A-Level Business Revision video, focusing on 3.1.1, understanding the purpose and nature of business. Today, we'll be specifically looking at the measurement and importance of profit. A reminder, my teaching here is separate from my consultation and teaching roles at any and all schools and academies throughout the country. My name is Mr. Giles. Let's get down to business. So firstly, we have to consider the concept of profit. And if you've ever studied business before, if you're just revising, if you're in year 12 or if you're in year 13 and you've encountered this a few times, this might seem a little bit trivial, but see if I can add a little bit of secret sauce to what you currently understand. Profit, as we know, is very simply the revenue from the business, that's the money coming in, minus the total cost going out. Fine, that covers the measurement part of it. We simply calculate profit, we have a number, and then hopefully we're able to compare that with an industry average or compare that with previous years. Pretty straightforward. However, there's a lot more to it. Profit is probably, and I'm going to use that word probably very carefully, probably the number one measure of performance for a business. And you'll likely, especially if you're in year 13, encounter questions where they'll ask you about things like success or performance or various other ways of calculating whether or not a business is doing okay. So this word here is very important because the minute you see that kind of command or trigger word of of success or performance, it's alluding to this. Now, if you're in year 13, you know that one of your 9 markers in paper 1 will be a profit question. You'll also know that in paper 3, it's highly likely they're going to ask you if the entrepreneur or the manager or whoever is the case study that focuses in on is doing a good job, whether he's a good leader or if it's the successful business, etc. This is where you want to go. And the reason why that's so important is because there are 2 elements to profit, and that helps guide us in writing the paragraphs we're going to write, because it will help us decide how many paragraphs we're going to write, usually 2, one about revenues, one about total costs. So let's see if we can shine a light and zoom in on some of these concepts. If we focus in on revenue first, the calculation is somewhat straightforward. We understand that revenue is the price of the product times by the number of products sold. Remember, revenue can be interchanged with things like turnover and sales. It's all the same thing. Basically, how much money is being made from the units that you're selling. These 2 elements here might become important because we might actually have to calculate revenue at some point. In year 13, that's less likely. It often comes up more in year 12. However, it's still important to know this because if we want to increase revenue, a business merely has 2 ways of doing that. First is the price. So they want to put the price up as much as possible. And then secondly, they want to sell as many as possible. However, that depends entirely on the context of the business. And I like to use the phrase "it depends" because, as we know, in either year 12 or year 13, when we're writing conclusions, and even when we're writing our analysis paragraphs, we need some "it depends." We need some critical thinking in there. So if we think about revenue, can all products increase the price? No, they can't. That's not true. You wouldn't walk into, say, Poundland, for example, and expect to find things for £10. It's in the name, isn't it? So not all businesses can increase the price because of price elasticity and income elasticity. Now, if you're in year 12 and you haven't studied those concepts yet, don't panic. If you're in year 13, I'm sure you'll find a video somewhere on my channel about them. So price is dependent on elasticity and quality and branding and all those other concepts. The quantity sold is also somewhat dependent on where the business sells its products. Is it international or is it only in the UK? Has it got really good distribution channels? Has it got e-commerce, etc., etc.? So these 2 bits are the 2 levers or the 2 dials, for example, that you would use to increase revenue, and the business will need to decide which is the most appropriate dial to turn up and increase dependent on what that business does. If you're Poundland, you need to open more Poundlands because you need to sell more. You can't really charge more. However, if you're Lamborghini, for example, chances are you're probably not going to sell more Lamborghinis, but you might be able to squeeze more price out of it by increasing the quality and adding the features. So that's revenue. Let's focus in on costs next. Okay, so we've got our revenue and we want to take away our total cost to find our profit. The formula, i.e. the measurement, is very simply the fixed costs plus the variable costs. Now, fixed costs generally don't need a calculation because they usually just give them to you, whereas the variable cost does have its own calculation. But before we get here, let's have a little bit of a talk about these two concepts because they're quite important again. Fixed costs are costs that do not change in relation to output. The number one example is usually mortgage or rent. So we talk about when we rent out a building or if we own a building, we pay that monthly mortgage. It doesn't matter how many units you sell, how many units you make, how many customers you serve, the rent stays the same, the mortgage stays the same. Now remember, those two numbers can go up, but they do not go up because the business is more successful or less successful. They go up because of inflation. So rent goes up because rent goes up and mortgages go up because of interest rates, for example. So fixed costs do not change in relation to output. However, there is a conversation that needs to be had about wages and salaries. More on that in a moment. Variable costs, as you can assume, are costs that do change in relation to output. The best way to explain variable costs would be your raw materials. Raw materials you're needing to make your products and sell your products, and the more products you make and sell, the more raw materials you need. So if you want to stock your shelves and you run a Tesco, every time your shelves empty, you have to buy more stuff to put on them. That increases the variable cost. The benefits or the beauty of variable costs is they generally only go up when your business is busier. Now, let's jump down here to this calculation. Variable cost is calculated as the variable cost per unit, so each unit of production, each unit of output, each unit sold, times by how many you sold. So if we go with our Tesco example, every time I want to sell a can of Coke, I have to buy a can of Coke. That might cost Tesco 50p. So 50p is our variable cost per unit. Well, how many cans of Coke did they sell? Probably 1 million. There we go. Okay. So there's our variable costs worked out. Now, the reason why we enjoy this one is because as this unit sold goes up, we might see a reduction in our variable cost per unit. Let me say that again. As the units sold increases, we may see a decrease in the variable cost per unit because of purchasing economies of scale. So again, if you're in year 12, you might not have encountered this. However, if you're in year 13, you should know. The more you buy of something from a supplier, generally speaking, the more you can hassle them or the more power you have to argue for a cheaper price. So if Tesco go to Coca-Cola and buy 1 million cans, they're going to get them for 50p each. The next year they go and buy 2 million cans. They might be able to come to an agreement for 40 pence a can. So as the unit sold goes up, generally speaking, the variable cost per unit goes down. Purchasing economies of scale. So we take our variable cost, we take our fixed cost, we add them together to get our total cost. If we're looking to increase profit, then we need to find a way to minimize both of these. Now, how do we minimize our variable cost per unit? Well, if we're saying our major cost is usually raw materials, we're either looking to get some economies of scale, or we might find a lower quality supplier. So that if it's lower quality, it's probably cheaper per unit. And if we're trying to reduce our fixed costs, we're trying to find a way to reduce our rent or our mortgages, which might explain the sudden popularity of working from home, because then businesses don't need to have big, massive offices and tower blocks, which reduces their rent. They pass that cost on to their employees. Now, there's those two bits there. I'm going to talk a moment about wages and salaries. So wages and salaries fall into one of these categories, both of these categories, sorry, okay? If you're not sure, if you don't know, a wage is money that you earn per hour. So if you went and got a job at McDonald's, for example, you would probably get paid an hourly wage. And that means you're paid for your time, not for your productivity. That is a very, very important distinction. You're paid for your time and not for your productivity. You could go to work at McDonald's, you could do the middle of the day shift on a Tuesday and serve 10 customers. You'd still get paid the exact same money if you did the Friday night shift and served 100 customers. You're paid for your time, not for your productivity. Now, that doesn't mean you're going to stand around with your hands in your pockets and do nothing, but you get the general idea. A salary, however, is a yearly sum of money that is divided up into 12 equal payments, and it is paid via performance. So that means you're paid for what you actually do. And it's not paid for what you produce per se, but what you do. And there's generally targets that you're going to have to meet in order to continue keeping your job. A wage, as you can imagine, is a variable cost. Because if you're into busy periods and you're asking your workers to work more hours, then you've got more variable cost going up. Okay, you need more workers, you've got to pay more wages, that increases the variable cost per unit. Whereas in slow periods, you would maybe get people to just work less hours. A salary, unfortunately, is a fixed cost because that person needs to be paid regardless of how many hours they work. You promise to pay them £50,000 a year. That's exactly how much you're going to pay them. No more, no less. Now, maybe that person works loads and loads of hours. I think like a teacher, for example, I work loads of hours between September and July. And then in August, I work very few hours, but I still get paid the same throughout the year. So my productivity is very high during the periods when I'm at work and then very, very low when I'm not. But what that means is that when I'm working, say, 50-hour, 60-hour weeks in September and October, I'm not getting paid anymore. But then when I'm only working, 5 or 6 hours a week in the summer holidays, then I'm not getting paid any less. So it benefits both parties, really. But the problem being is the fixed costs are an obligation. So if you're paying a salary and people are not being productive because they don't need to be, that's a problem. Whereas with a variable cost, with a wage, at least if it's a slow, quiet time, you can send people home and not pay them. So those are the difference between wages and salaries. So if we get to the end here and we look at the importance of profit, well, it's important because number one, it drives growth. It's paid to our owners and shareholders as dividends. So it's very important from that perspective. However, in the exam, you're probably going to be more asked about the question about how to improve this number. And very simply stated, we want to look for ways to increase our revenues and decrease our total costs. So if you're in paper one, for example, and it gives you the profit question, and they often ask you about an obscure part of the specification and its impact on profits, you're basically trying to work out whether or not it will help you to increase revenue or if it will decrease it. And then if it will help you to decrease the total costs or if it will increase it. So let's say, for example, it says exchange rates are changing. Okay, so the pound's getting stronger. Well, if the pound's getting stronger, will that help me increase my revenue? Well, yeah, because then when I'm selling abroad, I can be able to put my prices up, for example. Now, that's not really my choice because if the exchange rate is higher, then unfortunately people have got to pay more. But maybe then I'll sell more domestically instead. So it might be increasing my revenue from that perspective. However, it's definitely going to help me decrease my total costs because in the UK, we import a lot of raw materials. And if my exchange rate is stronger, then I get more for my money from abroad, which means my raw materials are cheaper from abroad. So that's what we're looking for in that paper one question. In paper three, for example, it's a little bit more abstract. It goes talking about that success. How successful has this business been? Or, is this person doing a good job? Is this the right thing to do? Well, if it's asking you if X strategy is the right strategy and you want to bring it back to profit, answer that question. Will this strategy increase revenue or decrease total costs? They often like linking that to things like marketing or operations. And they'll say, they're going to do this brand new marketing plan. They're going to start doing TV adverts. Well, is that going to help me increase revenue? Yeah, probably, because I'll get more customers. But is it going to help me decrease my total costs? No, it's actually going to put my total cost up. It's going to increase my fixed cost of advertising. So there's a lovely, it depends. Is it going to work? Well, it depends. Will the revenue increase outweigh the cost increase? Ta-da, we've got a lovely answer there. And you'll usually find that in the case study. That's been 3.1.1, the measurement and importance of profit. If you have any questions, please put them in the comments down below and I will try to get to them as soon as I can. Thanks for watching and I'll see you in the next one.